Yo, what's going on, everybody? It is Tuesday, December 19th. Break out the guns. So here's what's going on. We had like a 90 billion tax drain in the last 3 days ending Monday. So that Thursday, Friday, Monday, a 90 billion drain. So the deficit, the tax drain happened, just like I said was going to happen. What didn't happen was the correction that I was telling you guys that we were going to see. Sometimes things like that happen, folks. And I will be honest, I am very surprised that we did not get some sort of a pullback. And as a matter of fact, not only did we not get a pullback, but this thing is just zooming right up. And I really only have one explanation for that. I don't even know if it's the correct explanation. It's my explanation. But before I get into that, I want to mention some interesting things. Like today, for example, the biggest bear on Wall Street, this guy, Mike Wilson, who's the chief market strategist for Morgan Stanley. I've made videos about this guy over the last 2 years because this guy was the super bear pounding the table on how bearish the market was and how bearish the impact to the economy was going to be from the Fed rate hikes, okay? All along, throughout the whole entire time that the Fed was raising rates, this guy was like, the market's going down, the S&P is going to go down to 3,000 or below. And even when it started to come back, remember, I told you back in October 2022, that was the bottom because we passed the inflection point where the interest income flows from rising rates was going to offset the negative, or I would say the discounting effect from, the discounting effect to asset prices, financial asset prices from higher rates. There's that formula that discounts future cash flow based on, and in that formula, you got to plug in the interest rate. Now, I happen to think that formula is not good because I think there are assumptions in that formula which I think are wrong, but that's just my opinion. Every analyst, every financial advisor, they all use that formula, discounted forward cash flows, okay? Like when the rate goes up, then future cash flows are supposed to be less. But what that formula doesn't include is the fact that when rates go up, it equates to a fiscal transfer, and that means more money into the economy, and that's exactly why the rate effect happened only in the beginning, the negative rate effect, and that was mostly a reaction function on the part of people. And then when those interest income flows started to pick up, we saw the market, and I always said, let's just be honest here, because I know some of you have been critical of me. Let's just be honest. I've always said that the overarching view is bullish based on the fiscal, not just the interest income transfers, but just the fact that the government's spending $7 trillion plus annually with $2 trillion deficits. Those are massive transfers to the economy. I've always said that. Okay. And additionally, I've been hesitant to really talk about these quarterly cycles. And I've said in the past that I don't like to do that because I don't like to get you thinking in the short term. I think it's very, very important to stay with the macro picture. But okay, I got this particular cycle wrong with so far anyway. It still could be proven right. It just didn't happen on the day. And I know some of you out there, just if it doesn't happen on the day, I'm a liar. Fine, okay? Now, the other thing I wanted to point out, which I just alluded to, is you have some very high profile bearish market observers who are throwing in the towel, capitulating now and getting bullish. One of these guys I just mentioned is this Mike Wilson from Morgan Stanley. He said today or yesterday that investors now have the green light to buy stocks. I mean, after all this time, okay, that the market was going up. Never once did he try to, I wonder what's going on here. Like, you know, I don't know about Mike Wilson, and I don't know about some of you, but like if something is not working, I try to go and figure out maybe I'm missing something, you know? And that brings me, well, that will bring me to my discussion of what I think is going on right now, which is why we did not have a correction. Okay, I'm going to get to that. But I want to point out, and in fact, one of my subscribers told me that Investors Business Daily, that publication, says you got to be all in on stocks right now, 100%. I mean, they were not there. And I have another guy, a friend of mine, who told me today that their firm has, their 401k is managed by Morgan Stanley. And Morgan Stanley would send over a representative every quarter to give an update on their outlook. And the outlook for the last year was bearish because it was based on this Mike Wilson outlook. And he said they took a big hit on their 401k. But anyway, that's besides the point. What I think is going on here, and what I missed, is the fact that this is a massive, look, let me just say something first before I even get into this. It takes money to move the market, okay? It takes money to move the market. It's not about somebody giving a speech. It's not about somebody saying, you know, there might be a policy change next year at some point. It's not about a headline. It's all about money. That's why I follow these flows. And regardless of what happens right now, I'm going to continue to follow these flows because that's the basis of how everything works. And again, I bring you back to the big overarching macro picture, which is bullish until it's not going to be bullish. And when is it not going to be bullish? When these flows start to recede. And I have some thoughts on that too, like really, really big picture thoughts, like this thing I told you the other day about Jeff Bezos and the 10,000 year clock. That really made me think, like big picture perspective, but it's not that the time is not now. So what I think is going on here is, and it's not just that I think, I could see it in the numbers. I'm a numbers guy. I want to see the numbers, and to me, that's science, okay? If I see the numbers, I don't go by conjecture. I don't go by somebody said something. You know, maybe there's going to be a policy change next year at some point. All that stuff is meaningless. I understand that it could trigger behavior. But here's the point, because I had to say, well, we had a drain, 90 billion drain in the last 3 days. So where is this buying power coming from? I'll tell you where I think it's coming from. And again, I don't know if it's 100% sure, but the numbers seem to point that way. I think it's coming from liquidation. And by liquidation, I mean what's going on here is a record amount of short covering. Remember, when you're short and you're wrong, you've got to buy it back, either voluntarily or it's forced upon you by your broker. Okay, so we knew, the data showed that all last year, and I should say most of this year, there was a record short position in this market. It was evident in the options market. It was evident in futures. In fact, I talked about this. I think I mentioned this back in the late summer. I know I sent it out, you know, some data on this to my subscribers. But what I think is going on right now, because I see this in the futures market, big drops in open interest, that's liquidation. And by the way, when I say liquidation, it's not just shorts, it's long liquidation too. So you have to ask yourself, who's the shorts covering and who are the longs getting out? Because the longs, if they're getting out, you got to pay attention to them. You know the shorts are covering because they're basically being forced to cover as this rally, continues, and it kind of feeds on itself. That'll trigger more short covering and more. This massive embedded short position in the market is being unwound. Okay, and that's why even with the 90 billion drain, it hasn't had much effect at all. Now, once this short position is gone, what happens? The buying power is gone. Now, the problem is it's very hard to estimate or determine when that happens. I mean, I'm looking at futures open interest. I'm looking at, here's something interesting. Like, I've been noticing recently, and it's been kind of odd to me, why options market, the put-call ratio has stayed high. I mean, we had one day last week on Friday when it hit 0.77. That was like the lowest in a year, I think. But mostly it's been hovering around 1.0, maybe high like 0.95, 96. Even some days in this rally when it was above 1. And I thought that was odd. Like, what's going on with put volume? Why is it so high when the market's going up? Because usually you're going to see people rush into calls. They want to buy call. And then it dawned on me that put volume is probably high because it reflects the urgency of put holders to get out. This massive embedded short position being held in the form of put options, all being liquidated. And that's what's keeping the put call ratio high. I think that's my theory. Okay? Now here's something else. We're coming, tomorrow is a Social Security payment. So we're gonna have a net positive flow there. By the way, just to let you know, the government deficit for the month of December went from 107 billion last Wednesday to 15 billion. So there's your 90 billion drain. 90 billion drain. We get a Social Security payment tomorrow. We get a Social Security payment on the 27th. And then we get those normal first of the month, the big 100 billion day. That's probably going to come on the 30. What day is the 31st? Is that that's a Sunday? So the 30th is a Saturday. So Friday's the 29th. It might come on the 29th, or it might come on the 2nd. I don't know when it goes out. But around that time, we'll get the big hunt. So we got 3 big boom, boom, boom positive flows coming. So what does that mean? It means we can get this could be a blow-off rally into early January. And then we get a quarterly interest payment in February. And by the way, if you go back and if you listen to my videos, I said that once we get through this tax drain, which I did think was going to create a pullback, I said we're good until mid-February, and we're going to make new highs until mid-February. I mean, I've been saying that. I've been repeating that. And again, not to try to skirt the issue, because I know a lot of you want everything to happen on a particular day, but I've been very consistent in saying that the overarching environment is bullish. 7 trillion plus a year, 2 trillion deficits, massive transfers into the economy. But I'm just pointing out, you got guys like Mike Wilson now. I mean, it's astonishing to me that a guy at this level on Wall Street, and I'm sure his compensation is in the millions, can be so wrong for so long. I mean, and just now saying, hey, you got the green light to buy. Now you got the green light to buy. All right? Not last October, not even, in June or September. Now you got the green light to buy. I mean, it's incredible. It's incredible. So that's my update for today. And this is a chapter that is not finished yet. Okay? Believe me, this is in fact, it reminds me a little bit of early 2020, January, when I remember the flows were pulling back at that time. I had a bearish view. I said, and it was also a time when a lot of people who were bearish on Wall Street, they flipped around in January 2020, and they're like, now you got to go in. This is going to be the biggest year ever. And boom, what happened? We had the COVID pandemic. And I'm not saying we're going to get another COVID pandemic. I don't get involved in trying to, forecast non-economic events. I have no idea, and nobody knows, or geopolitical things for that matter. I just think we're not on the inside. We don't know. I stick to my numbers when it comes to economics. But I'm just saying the environment reminds me of that. We'll see. Anyway, that's it for today, folks. Bye.